Good morning, and thank you to everyone, both in person and virtually, for joining us today. I'm David Dworkin. I'm President and CEO of the National Housing Conference. And the National Housing Conference is the oldest and broadest housing coalition in America. Founded in 1931, we are a diverse continuum of affordable housing stakeholders who convene and collaborate through dialogue, advocacy, research, and education to develop equitable solutions that serve our common interest in America, where everyone is able to live in a quality, affordable home in a thriving community. We're honored to co-host today's forum, Federal Home Loan Banks, Shaping the Future of Affordable Housing and Community Investment, with the Federal Home Loan Bank of San Francisco and the Council of Federal Home Loan Banks. For nearly a century, the Federal Home Loan Banks have been a cornerstone of stability, ensuring that financial institutions remain liquid, responsive, and committed to the communities they serve. Through their unique cooperative structure, they provide a crucial bridge between financial institutions and the housing market, enabling affordable housing initiatives, homeownership opportunities, and economic development across the country. Today's discussions will explore how Federal Home Loan Bank programs are being utilized by member banks to create real, tangible change, and how they can do more to address the affordable housing crisis we are experiencing today. From workforce housing to homeownership initiatives and broader community development efforts, we will hear how financial institutions are leveraging the affordable housing program to make a meaningful difference. But as we look ahead, we must also ask, how can we maximize the impact of these programs? How do we ensure that the Federal Home Loan Banks continue to adapt and modernize to meet the housing challenges of tomorrow? As we approach the Federal Home Loan Bank System's 100th anniversary, this is the moment to reflect on its legacy and chart a path forward, one that strengthens its ability to serve communities in an ever-changing financial and housing landscape. Throughout today's sessions, we will hear from distinguished experts who will provide insights on the Federal Home Loan Bank's impact, opportunities for growth, and strategies for ensuring that these institutions remain a force for housing affordability and economic stability. Before I bring our next speaker to the stage, I want to give a quick overview of how our Q&A portion for today's sessions will work. On your tables, you will find index cards. If you'd like to propose a question to the panel, please write on the index card and hand it to the NHC staff who will be walking around to collect the questions. Now I'd like to introduce Jeremy Empole. As Vice President of Government Relations at the Federal Home Loan Bank of San Francisco, he plays a critical role in overseeing the bank's engagement with Congress, regulators, and financial industry stakeholders. Before joining the Federal Home Loan Bank of San Francisco, Jeremy spent 16 years as Senior Vice President of Federal Government Affairs at the California and Nevada Credit Union Leagues. He has also served as a congressional aide to 3 members of Congress, advising 2 members of the California State Legislature, and working on numerous political campaigns. Welcome, Jeremy.
Good morning, everybody. Thank you, David, and thank you for your extraordinary leadership in the housing and housing finance arena and that of the National Housing Conference. You, your board, your advisory council, and your exceptionally talented staff are literally making a difference for millions of Americans. Speaking of that staff, because we got to help plan this together, I want to recognize a few people from your team, Cara and the 2 Britneys, who've worked so brilliantly with us to make this event so positive. So quickly, give them a round of applause. It is a privilege to be here on behalf of the Federal Home Loan Bank of San Francisco to co-host this event with the National Housing Conference and the Council of Federal Home Loan Banks. We greatly appreciate this opportunity to bring people together, so many voices, to confer on the topic of home loan banks. Much as David just pointed out, the home loan banks have been here since for about 93 years, come this July. And we've always met the ability to change to the rapid changing environments of Washington, D.C. and our nation. And that's an era we're certainly in now. So it seems appropriate at this moment to take a second, take a step back, take a hard look at so many of our institutions, especially those in housing and community investment, and take stock of what is going on, what's needed, and where we can make changes. And that's the power of convening, something we know very well at the Federal Home Loan Bank of San Francisco and all of our 11 banks. We convene like this, but we do that at our regional and local level. Across our 11 regions, we listen with stakeholders, we gather them, we talk, we listen, and we take in what they need in the housing and finance challenges, and then bring them together to bring solutions about. And we do this almost weekly, daily, with many of my colleagues that are here in the room. And that's exactly why we sought to create this sort of symposium, is to bring like-minded folks together to talk about what exactly is needed as the home loan banks continue to progress. To that, I want to strongly encourage all of you to participate in this. As David outlined the rules for using the cards on the table, ask our panelists some tough questions. That's okay, because we're here to listen, we're here to talk, but we want to make sure this is a dialogue and that we all engage in this. And that gives us a chance to all add to that convening power. From our end on the Federal Home Loan Banks, as I mentioned, there's quite a few of us from the banks in the room and I'm watching online. Hello to our family and friends back home. We want to make sure this isn't just a commercial for the Federal Home Loan Bank system. But that's going to be hard for us because we're tremendously proud of the work we do every day back home in our communities with our member institutions and with the communities that we serve. And we do want to tell our story. We're eager to do that. It would be a challenge for us to name another institution in America's housing and finance sector that is so unknown as the Federal Home Loan Bank system. And that has created an opportunity for us to tell that story in a different and unique way. And that is largely also driven by the fact that our cooperatives are mostly behind the scenes for our member institutions. And again, people don't understand that we are cooperatives. We are member-owned. We are privately capitalized banks that are working with your regional community banks and credit unions on a daily basis. So this helps us get our message out and get a chance to tell our story. But we're also here to listen. And that's an important factor. And we have done that, as the council has done and led over the last year or two with the System Out 100 report and other opportunities that have happened. And when we hear those messages in, we're able to take them together, have a nice dialogue, productive conversation, and then move forward on solutions that are workable for all. So there has never been a time more so than now for all of us to adopt that model. Listen, learn from each other, collaborate, and move forward with workable solutions. And then with that spirit, on behalf of the 11 Federal Home Loan Banks and our 6,500 member institutions, I want to thank you for being here. With that, I get to welcome our first speaker to the dais here, Professor Jill Cetina, who will also moderate our first panel. Jill is an executive professor and associate director of commercial banking programs at the Mays Business School of Texas A&M. She's widely respected for her research in financial supervision, her expertise in capital and liquidity, and the intersection of monetary and fiscal policy. Prior to joining Texas A&M, Jill was associate managing director for U.S. banks and government-sponsored enterprises at Moody's Investor Service. And prior to that, she was the vice president of supervision at the Federal Reserve Bank of Dallas. Her tenure at Moody's, her seasonality at Texas A&M, and of course the Dallas Fed make her an expertise in this field. Please welcome Jill Cetina to the stage.
All right. So, get my clicker going here. All right, so the title of this talk, we're obviously going through a period where there's quite a bit of, I'll say, economic policy change, I think it's fair to say, in DC. And I spent the beginning of my career in DC, and then, as Jeremy so graciously indicated with that introduction, moved to spending some time working in Texas and then New York. So the title of this talk is really, kind of my main takeaway, which is just that we, in terms of economic policy in the United States today, are trying to navigate some complex national security and macro-financial challenges. But the thing that I want to really lift up in this talk is that we need to, as we think about these very significant policy changes, make sure that we are considering the impact on the young and on the next generation of Americans. And I'm going to speak both about how we got to this place where we think we need very significant economic policy changes, but also some of the changes that have been proposed and what they mean for the young. I like to, for my students, and I recognize that this font may be a little bit small, but I'm sure the slides will go up. I like to kind of summarize what are my main points for my students, and so I did that for this talk as well. And basically, I think that the story of how we got here in terms of such dramatic economic policy changes dates all the way back to the Great Depression, and when we had a crisis that we had difficulty getting out of, and we changed our system of money away from a commodity-based theory of money that was focused on having our currency backed by gold and silver to more of a credit-based theory of money. And this credit-based theory of money, which we have basically pursued since the time of the end of World War II, has allowed for a great financialization of wealth on the part of US society. It's also democratized leverage in our society. And basically, this financialization has had a number of good things in terms of raising living standards, but it has also had, I'll say, some downsides in terms of creating greater demand for, I'll use the word bailouts when we have disruptions in the financial sector. And these bailouts can prove quite costly. And the challenge that we face is that on the one hand, we want there to be, because we all share in participate in capital markets, 50% of Americans own stocks, which is much higher than in many other countries. We basically want to have these bailouts, but at the same time, we want to ensure that credit continues to flow. So we're not particularly consistent in our support of guardrails in terms of financial regulation. And my argument is that these dynamics over time, in terms of this fiat system and a credit-based system of money, have left us with significant fiscal, monetary, and financial sector challenges, and that basically this system has disproportionately benefited certain parts of US society, in particular older generations. They've benefited more than younger generations. Now we have an administration that is understandably seeking to address some very real national security risks, and doing so in terms of reindustrialization. This is a policy priority, as is dealing with our very elevated public sector debt stock. How is the burden of these adjustments going to be borne in US society? And one of my key messages is that I am concerned about some of the policy proposals that have been put forward, that there is not enough, I'll say, generational burden sharing. So I think we need to think very carefully about this, because one of the challenges that we face, and this is relevant certainly when we talk about housing, is the changing demographics and the fact that we are going to slowly get into population decline, and that without making housing and a range of other things more affordable for younger generations, we will inadvertently accelerate that population decline. I'm going to be a little bit more quick, speedy on some of my other slides, but I want you to understand my broad framework and kind of where I'm going. And what I'm trying to say here is that basically, we have had this deindustrialization that has gone on, and we have had critical industries leave the US. And at the same time, we have built up very significant debt. All three of the main channels of credit creation, the monetary system, so the currency, is in a place where it's fair to say that there is some flux. I'm going to get into each of these points in greater detail in my subsequent slides. We also have allowed our official sector to become over-leveraged, which was a process that really accelerated following the global financial crisis in 2008. And then finally, we are in a place where we are potentially getting ready to deregulate and desupervise very significantly in order to accelerate economic growth. But the lack of guardrails around the financial sector is what can bring us the next crisis, which is costly. All right, I promised I was going to step through each of these three channels. Currency. So there's a paper that I love and I like to teach my students about, Levin and Valencia, from the IMF. It is a beautiful paper about the history of global banking crises since the introduction of fiat currency. And in that paper, they introduce the idea of a definition for a currency crisis. And if we were to look at gold and Bitcoin, the price action that we have seen in both of those assets relative to the US dollar over the last 2 years would meet the IMF's definition of a currency crisis. So why is this going on? Why have we had this, I'll call it depreciation of the US dollar against these other stores of economic value? Well, some of this is that we have had foreign central banks decide to pull back from what they are, just their holdings of the dollar. And this is in light of the fact that we had sanctions that we put on many countries, understandably, after the invasion of Ukraine. China, of course, is trying to figure out what to do with their dollar balances, and as many are aware, they have stepped back from their holdings of treasuries. So this is sort of another source of pressure. It would be remiss to not also remark on the fact that we had inflation get up to, in terms of CPI terms, in excess of 9% during COVID, and that to some degree, and we remain, of course, above target, the Fed's target for inflation even today, and that to some degree there is a concern about what is happening in terms of monetary stability, price stability, and that this as well is probably a contributing factor. And then finally, the overall economic policy credibility, I think it is fair to say, is under scrutiny today. Why do I say this? Because when we look at what happened in the fourth quarter of 2024, when the Federal Reserve began to cut interest rates, the reaction of long-dated Treasury yields were to rise, and to rise in a manner that completely offset and actually, we ended up with higher interest rates at the long end, higher mortgage rates after the Fed cut rates as relative to before. Additionally, we are in a situation where people look with some concern at how the administration speaks about, I'll say the future of the Fed and the independence of the Fed. And fiat currencies, what backs them is trust, okay? And so I think these are questions that we have as we look at currencies and the US dollar. The reserve currency status of the dollar is very related to the Treasury market. And in this chart, what I'm showing you is over time, all the way back to basically just after the end of World War II, the level of official sector debt relative to GDP in the United States, as well as our budget deficit relative to GDP. Our budget deficit to GDP today is about 7%, which for not being in a recession is extremely elevated. Our debt relative to GDP is in the order of magnitude of about 100%. This is about the level that US debt was at when we exited World War II, okay? So these are, it's hard not to look with some concern at where we are in terms of fiscal sustainability. And yes, these are our domestic currency obligations, but this is where the, I think, question about the currency and its soundness and inflation starts to come in. We, as I've already remarked, have foreign buyers pulling back from the Treasury market. We do not have, for this level of debt stock, sufficient financial institutions that have I'll call it a liability structure that allows them to buy Treasury assets and hold them without being concerned about mark-to-market revaluation. This is basically a picture that is, I think that the administration recognizes and is trying to, in some fashion, change. So then we come to the financial sector. And bailouts, we had a massive one in 2008. And as I alluded to, these bailouts were very significant. And, basically, I think you can trace some of the polarization, if you will, politically, around financial regulation to the 2008 crisis. Of course, when we had what happened in 2008, there was a very significant public policy response, both in terms of fiscal and even more so in terms of monetary policy. We completely changed at the Fed the structure of monetary policy and began to do unconventional monetary policy, which unfortunately may have contributed to less sound fiscal policy over time, okay? So we made all of these changes, and there were parts of society, those who had wealth, who benefited to a significant degree from those interventions in terms of having their wealth preserved, or even as a result of interest rates and significant monetary creation, the nominal value of their assets increasing, okay? So these bailouts, we just have not had sustained support for putting guardrails to prevent future crises. And I recently joined A&M after having been the head of U.S. bank ratings at Moody's, and I can tell you that the topic of broad balance sheet management, asset liability management, interest rate risk management is a problem. It was a problem not just for SVB, it is a problem for other U.S. banks. And if you believe, as I do, that there are risks that interest rates remain volatile given this broad macro financial backdrop, this is potentially itself a source of concern, not to mention the fact that we have over $1 trillion of U.S. bank lending to non-bank financial institutions. So we are in the process, I think, of getting ready to change U.S. financial regulation, and I want to inject a note of caution here that banking crises, at the risk of being obvious, can be quite costly. The IMF reminds us from their research that the median cost for an advanced economy of a banking crisis is 35% of GDP, with a very long tail that is to the right, meaning it's even more costly than that. So these are things I think we really need to think about. Okay, Professor Cetina, this situation has persisted for decades. So why is it a problem now? My argument is that all of this system that we have built up since the end of World War II is a problem now for two reasons. One, we're deglobalizing, and two, we are going through a demographic transition. So specifically, how does this relate? Well, we basically, and there's a beautiful book that I have referenced here by Charles Goodhart, who is a professor of banking at London School of Economics, and Manoj Pradhan, who was formerly with Morgan Stanley. But this book, and they started it off as a paper of the Bank of International Settlements, talks about the demographic transition and makes the point that China's accession into WTO, as well as the collapse of the Soviet Union, were huge disinflationary shocks that we, to some degree, took for granted. The Soviet Union's collapse brought significant commodities into basically the global economy, while China's accession into WTO brought significant labor into the global economy, all of which was disinflationary and depressed prices. These trends, at the risk of being obvious, are over. We are creating, again, at the risk of being obvious, it seems to me that we are creating kinds of zones of economic influence where we will, in the United States, be focused on, say, the Americas, so something more akin to the Monroe Doctrine, and we will trade less, significantly less, with these other economies. At the same time, we are going through a demographic transition where we are losing the working age population, and the share of the older generation is rising, and this is going to stress our highly levered system. So, my appeal to those in the room, those online, anybody who's involved in policymaking, we need to start a dialogue now. We need to start a dialogue now because when you look out at all advanced economies, you see the same pattern of basically a demographic collapse. It's most pronounced in Japan. It's also existent in Europe, but we could try to be different. What have I graphed here? I've got the change, these are census data. For my blue line, basically this is the year-over-year change in the number of Americans who are over 65. So we've got a very significant share of Americans who are aging out of the workforce. The red line, by contrast, is growth in the working age population. And these are census projections out to 2100, okay? And so the challenge here is that if we don't make housing, if we don't make life affordable for the younger generation of Americans, these census projections will be revised down further. As I was preparing this presentation, I became aware that the census just revised down their projections for US birth rates. Again, we need to think carefully about how we're apportioning, I'll call it the transition costs associated with the new world order that seems to be born. So we need to have that discussion, and it's a national dialogue. The administration has a challenging situation. They are trying to strengthen the US national security position, and they are also trying to deal with a difficult fiscal situation that has built up over decades, over parties, both parties, both Democrats and Republicans have allowed this to happen. What I've done here is I've tried to take what are some of the main policy proposals that this administration is pursuing as a part of, again, trying to reindustrialize and trying to address the fiscal situation. And I'm going to speak to how I view the impact of these policies on this topic of younger generations and making it possible for them to form families and for our country to have a future. So first, tariffs. It was stated in the inaugural address that the purpose of tariffs is for us to gain revenue, in effect to help defease our debt. Understandably, countries that have a long tradition of being allied with the United States are in shock and don't appreciate this approach. The goodwill of our allies, goodwill is an asset. Goodwill in terms of national security, goodwill in terms of their willingness to continue to hold the dollar as a reserve and invest in our economy. We have a net international investment position, meaning foreign investment in the United States is minus 80% of GDP. They own stocks, bonds, quite a few things. We need to maintain goodwill and be a bit more perhaps diplomatic. The budget. Discretionary budgetary expenditure, we all know, we've all been reading the headlines about what's happening with the DOGE initiative, and I welcome that. I think we're going to need to look very critically at the fiscal situation, but we need to basically put it all on the table. We need to put Social Security and Medicare on the table, and we need to put tax expenditures. Tax expenditures, if you've ever read, most people have never read, and it's not even in the CBO documents, but the Senate Joint Report annually on tax expenditures, it's equivalent to discretionary expenditures. What are tax expenditures? These are basically tax subsidies that we give to high-income groups in the United States. So I think all of this needs to be on the table so that there truly is a discussion about burden sharing in this difficult fiscal situation. Oil and gas. We want to expand oil and gas. I'm from Texas. I like oil and gas. But, from having worked in supervision at the Dallas Fed, I've looked at bank lending in oil and gas. So very familiar with this industry. I like it. But in Texas, we actually like all energy. We like nuclear. We like renewable energy. We are an energy state. And I think one of the things that's really important, and we've seen this time and time again, if we don't continue to invest and research other technologies, we will fall behind. And we need to maintain our leadership in all types of energy. That's a message from a Texan, okay? Reindustrialization. Basically, if you're talking about reindustrializing the US, which I welcome, what you're going to need to make that happen from a GDP viewpoint is you're going to need to reduce consumption. And the question is, whose consumption are we reducing here? If by virtue of the fact that many older Americans have more wealth and more assets, we're reducing the consumption of people who are attempting to raise their families, we will have less children. That will be the outcome. And so I think we need to think very carefully about the low-income groups, the younger generations, how tariffs, particularly for those who are lower income, apply to them. okay? Selling assets, whether it's privatizing Fannie and Freddie or selling gold or various other things that have been talked about, creating a sovereign wealth fund. Assets are, when you take Accounting 101, you learn assets are a future economic benefit. And so if we dissolve these assets, if we sell these assets and we have not reformed Social Security and Medicare, those future economic benefits will effectively end up going to the oldest generations of Americans and not be shared equally. Deregulation and desupervision, and some of the things that we want to do with the Treasury market. When I talk to people about what do they hear or what is the discussion in terms of changes that may occur for US banks, one of the top things that I hear people talking about is we're going to change the treatment of Treasury securities on banks' balance sheets. We're going to take potentially Treasuries out of the leverage ratio. And this, I think we need to recognize it for what it is. This is trying to communicate to banks that there are no risks of Treasuries. For those of us that painfully lived through Silicon Valley Bank's failure, we all know that is not true. During the 1950s, it was possible for US banks to provide very significant balance sheet capacity to fund the US government. It's also important to remember that in the 1950s, we had interest rate controls on deposits. And that's something that changed in the 1980s. It is not possible today. After SVB's failure, we did nothing to change bank regulation around asset liability management and interest rate risk at US banks. This is the third time in US history we have had US banks fail due to excessive interest rate risk. We don't seem interested in learning. So my caution to all bankers in the room, I wouldn't go out beyond 3 years in terms of my holdings of Treasury securities, no matter what someone tells you from a regulatory perspective. We need to think about how we regulate our banks so that we do not end up with that negative tail of bank failures and financial crisis. And finally, stablecoins, let's call it what it is. Stablecoins will be a nice repository for a growing share of T-bills, okay? That's why we're doing this, but this will maintain pressure, funding pressure on banks. It will siphon off some of their deposits. So I've offered, I guess, my view of why I'm concerned about some of the policy proposals. I understand the problem, and I applaud the administration for trying to address some of these national security problems and problems of unsustainable debt. But at the same time, I have some concerns about, again, the impact on future generations of Americans, okay? So let me offer some alternative ideas. I'm not saying they're all perfect, but I think we need to maybe bring some ideas that restore a little bit more balance and opportunity for younger Americans. Again, on fiscal policy, I'm calling for a zero-based review of everything, including Social Security, Medicare, and the tax expenditures. I think actually Secretary Bessent has a lot of empathy for some of these points, but I think we need to really get Congress to have a more all-hands-on-deck approach to this. I think we need to set a budget deficit target. We have not done this. Before the end of the Bretton Woods system, when we had fixed exchange rate regimes, you could not run a budget deficit above a certain level of GDP sustainably. That anchor for us is gone. Maybe we need to try to restore our credibility through adopting an anchor and enforcing it. And this would help younger Americans if we could lower interest rates, right? This would be very beneficial to younger Americans if they were able to access credit to purchase a home at a lower interest rate. Housing policy, and I recognize I'm talking to a group of housing policy experts, and this may elicit a bad reaction, but I think we need to recognize what's going on in Japan. What's happened in Japan is that as they are going through their demographic transition, they literally are giving away houses. They're giving away businesses. They don't have people to take these things. If that is a bit our future, okay, maybe what we need to do is find ways to incent the existing housing stock to be more efficiently redistributed towards younger generations, again, so that we can stabilize our demographics. If you take nothing else away from this presentation, my hope is that you take away that I'm trying to call for policies that allow our younger generations the space to be able to form their families, live their lives, and contribute productively to our economy and society. So I think things that help reduce home prices and incent people who may have invested in residential real estate in a manner that they're trying to use it as an investment vehicle. If we can turn that house into a house that a young family can live in, that's a good thing. We maybe don't necessarily need to build as many new houses. In terms of financial sector policy, in American Banker, I did an op-ed in December where I called for the consolidation of the federal banking regulators. Why do we have the inefficient and broken system of federal supervision of banks that we have? We have it because it's easy from a lobbying perspective to fragment the regulatory system. We need to change this. It's also costly. There's many efficiencies that can be unlocked through this. I've written about it. In terms of financial sector policy, in my view, from my time at Moody's, there was, I'll say, a bit of a conflation of correlation and causality with regards to home loan bank advances. So as the Fed tightened monetary policy, there was a significant uptick in home loan bank advances. Many bankers, as I've already alluded to, were not aware enough about their asset liability management, and they came in and they borrowed from home loan banks when they should have done that when rates were super low. The home loan banks were not the cause of bank funding stress, and I think that they have a very important role to play in terms of providing stable funding sources to banks as we go through this significant economic transition. I think we need to reduce the risk of future crises in banks by moving forward with the bail-inable debt proposal for the regional banks. We in the United States, in the United States, beg your pardon, only have bail-inable debt for our 8 largest GSIBs. And this was a problem for SVB and some of the other regional banks. We need to carry that proposal forward. Additionally, I think we need to think about ways in which we can create rules around executive compensation and have bankers have more skin in the game. This has been something that has been talked about. It was in the Dodd-Frank Act from 2008. Nothing ever happened with it. Nothing since 2008. So in terms of healthcare reform, it's not my specialty, but the gentleman who was my professor of finance, Uwe Reinhardt, his brilliant book, Priced Out, I encourage you to read that, makes the point that somewhere between 25 and 30% of US healthcare costs, they arise because of basically the fact that we have this complex multi-price system of insurance. So healthcare is one of the great areas for disruption in the US economy where we could improve economic efficiency. And in my own area, where I work now with students to whom, again, this talk, my students are the people to whom this talk is dedicated, I think that it's really important that we think about, in higher education, how can we reduce administrative expenses and costs and make education more affordable to many. I think vocational education will be very important as we try to reindustrialize. And finally, I'm going to make a plea. At our university, Texas A&M, we are very involved in STEM. We are a public university, and 25% of our students are first-generation college students, okay? And we are, by virtue of being agricultural and mechanical, A&M, we have a lot of scientific research that's going on. The discussion that's going on about administrative overhead is very critical to universities, and even more so for public universities, because we are not running a hedge fund over here on the side where we can, from the endowment, could have or maybe should have taken money out to fund the graduate students, fund the labs, and the other things. So that is, I think, another way in which, these are important things for young people to have those educational opportunities. All right, with that, I welcome your comments and questions, and I hope that this was a valuable way of kind of framing the world today.
Is mine on? So we have a couple of questions. The first is, we often hear that the FHLBs receive subsidies from the taxpayer. If that subsidy is a discount from investors, how are taxpayers on the hook, and how do you monetize that subsidy?
How do you monetize the Home Loan Bank subsidy? So I actually think the U.S. economy benefits in very important ways from having the home loan banks. When I was at Moody's, the whole U.S. banking sector, there is a macro profile, okay? And that macro profile for any banking sector that Moody's rates, Moody's of course rates banks all over the world, is informed by a lot of different environmental factors. In the United States, that assessment of the U.S. banking sector's macro profile receives benefit from, by virtue of the fact that we have the home loan bank system, and that the home loan bank system can provide stable term funding, particularly to smaller U.S. banks. So, the FDIC did a very nice report, which was at the community banking conference that was held in the fall in the St. Louis Fed, was when Chair Grunberg unveiled it, and talked about how important community banks are to small business lending. Small business lending is 50% of U.S. employment. So I guess I would kind of turn the question around. Like, to me, what the home loan banks do in supporting smaller banks, providing them with stable funding structures, making sure that they are continuing to lend to small businesses, this is crucial. I'm not looking to monetize it. I'm looking to keep it and maybe expand explicitly what the home loan banks do to ensure that the government, this very high level of government debt, doesn't crowd out small business lending, that we don't clog bank balance sheets with treasuries, but instead we're able to ensure that home loan bank advances, maybe in addition to supporting housing, that it becomes socially acceptable. I know that under statute that it's acceptable, but that it becomes something that is used also to support small business lending in those communities.
Great. And our second question, what is your view about how immigration policies can help maintain appropriate levels of younger people in the U.S.?
Yeah, so I think this is a great question. It's important to recognize that immigration has contributed almost all of the increases to the working age population basically since COVID, if you look at the data. So what we are engaged in right now with our immigration policy is demand destruction. And we are in the process of reducing overall economic growth through what we're doing with regards to immigration. Not going to say that I didn't speak about immigration policy in my talk, but I think that this is a way in which there will be, I'll say, some near-term negative pressure in terms of the economy. I think these are questions that people have to debate/decide what's the appropriate level of immigration, but it is without a doubt a variable that we had turned up very high, and now we've flipped very strongly in the other direction. And I expect that we will see that in the data, the economic data, in the coming months.
Thank you. And our final question, could you elaborate on your proposal to remove SBA lending and how the FHLBs could step in? Yeah, so I think that there's opportunities to think about what are the most efficient ways. I mean, the administration, you can agree or disagree with it, right? But it feels like there's a lot of potential for things to be put on the table. And I guess my question is, home loan banks have very strong connections already with many of the smaller banks, the community banks, who are themselves very actively involved in the small business lending space. So is there an opportunity to perhaps improve overall efficiency by maybe taking the guarantee authority out of SBA and instead, creating real support that's upfront for home loan bank advances to support small business lending? I know that when home loan banks are involved with members whose balance sheets are perhaps not as focused on housing, that there can be, I'll say, some clutching of pearls about that. And I think that's not appropriate. I think that when the banking sector is intermediating credit to small business,
That's a great day. It's a great day when they're lending for housing as well, but all of those things should be celebrated, particularly because these smaller banks are serving rural communities where large banks in some cases have no interest in stepping in, and that's why we see the growth of banking deserts in the United States. Other questions? I welcome the discussion, I really do. These are important topics. All right. If we're good, then I'm going to transition us to our panel. I'm going to call my co-panelists up, and I thank everyone for the questions and the time and attention. We're going to switch over to that, so if you would join me on stage, gentlemen. It's good to see you, Stockton. Yes. Joe, good to see you. Great job. Aaron, thank you. All right, well, I'm going to move down one. Since we are four, Sarah McFoy, who was originally going to join our panel, had some challenges making it out of New York, unfortunately. So it is us to talk about the home loan banks. And so for this panel, I'm hoping that we will kind of do three things. First, I'm going to kick off with just a couple of reflections on this topic of bank liquidity, bank funding. Then I'm going to go through some questions with my panelists and discuss the home loan bank's provision of advances. And then we want to take your questions. So I'm going to try to see if we can do those three things in our hour together. All right, so first in terms of just my broad reflections, I've mentioned already community banks in my opening remarks, and I think one of the things to kind of be cognizant of is when you look at CSBS, or the Conference of State Banking Supervisors, does a very nice survey of community banks, and their survey from 2024 shows that, despite the fact that for many people perhaps in the room, the bank failures of 2023 may feel like a distant memory, to community bankers, they ranked liquidity risk as the second highest risk, okay? This was at the end of 2024. And their perception of liquidity risk for their institutions was not much changed relative to 2023. So in this environment, I think it's just really important that we continue to provide banks with a broad range of tools to be able to manage their balance sheets successfully, including home loan bank advances. I was looking at the data for the Senior Financial Officers Survey in prepping for this panel, and September, unfortunately we don't have anything more recent than September 2024, but that survey shows that 24% of domestic U.S. banks surveyed planned on significantly increasing their use of home loan bank advances. And bankers that I talk to, the banking program that I teach in, we have 50, 60 banks that thankfully come and hire our kids, our students. And we, of course, discuss how are things at your bank, what's going on in Texas, as many may know, has a very active banking environment. Many of them make, I will say, good use of home loan bank advances in providing credit intermediation in our state. So those are just, I guess, some of my high-level reflections on the topic of home loan bank advances. And with that, I'm going to start to bring in our panelists. And the first question that I wanted to ask related to the events of 2023, and the question of your perspective on, home loan bank advances and the bank failures in 2023, this has been kind of a debate. I'm just kind of curious to hear different kind of points of view on this. So maybe, Aaron, I'll start with you since you're sitting right next to me.
Thanks. First of all, I want to thank the National Housing Conference, and I want to thank the Home Loan Bank Council for having me, particularly for having me. I realize I may not be the most popular person in the room, but I want to commend you for having a different set of voices. As somebody who's been in this game for a long time, particularly on the think tank and event side of things, there is nothing more boring than having four people one-up each other in agreement. I don't think the audience and the conversation benefits more. So even if I'm proven dispositively wrong in this conversation, it is a credit and a testament to the organizations for putting me on stage. Jill, I think that two things can simultaneously be true.
Okay.
I can think that the home loan bank system provides massive value for the vast majority of banks of all sizes, but definitionally, the vast majority of banks and credit unions are small. And simultaneously, that the troubled institutions have an over-reliance on the system. And so I think those two statements can simultaneously be accurate. And I think the crisis of 2023 proved that. You had Silicon Valley Bank go from 0 to 60 in their home loan bank borrowings. You had First Republic, which was, I think, the second largest borrower from there. I go back, my bank history crisis goes back a long way. I remember IndyMac, which was running between then the Seattle and San Francisco home loan banks, pledging assets that the discount window wouldn't take. The failure of IndyMac never got the attention it deserved as a case study in crises because it was so quickly eclipsed by much larger failures. But it is deeply illustrative. It was one of the largest expenditures. And there was a tiny bank that failed in Kansas subsequent to 2023 that also I think had no history of home loan bank advances.
That was a fraud one, right?
And within a month, 20% of its assets was pledged. It turned out the CEO of that bank had been swindled by a crypto scammer and was quite literally wiring the bank's capital to a crypto scammer in Asia.
It's a pig slaughtering thing.
That's the type of scam it is. But the point I'm making is, when you study just the troubled institutions, a constant pattern emerges of sharp appreciation of the home loan bank system as the trouble is escalating. And that is not an inconsistent reality with what you're hearing from your 60 banks in Texas. And that, I think, is the root cause of many of the positions that I take, which is that it is repeatedly the case that when institutions get in trouble, they rapidly increase their home loan bank borrowing.
Maybe just one quick thought on that, though, Aaron, is that when an institution's capital position becomes challenged and then they need the additional liquidity, they're going to turn somewhere, whether it's the discount window or home loan banks, so that it's really kind of a story of we've got capital challenges and they're going to try to find some way to reliquify themselves.
Right, but there's a bit of a three-card Monte here in capital and liquidity, right? In the sense that people say, well, banks always fail because of a liquidity run, right? And then the question is, well, there's a liquidity run because their capital situation is poor, right? Silicon Valley Bank was broke in November. It failed in March. Its stock price was $270 on Monday and 0 on Friday, right? A bunch of various market indicators, for whatever set of reasons, had radically different valuations in a simple book reading of it. The problem becomes the difference between the position of debt and equity in a bank failure, which banks are unique. Banks do not go through bankruptcy. I can't tell you how many constituents, when I worked on the Senate Banking Committee, would call us up with a complaint about bankruptcy, and we had to tell them to go to judiciary, and they thought we were passing the buck. But I would say banks are the only thing, right? They're chartered entities. I'm unaware of many other industries that are exempt from bankruptcy law and have a special receivership. In special receivership, the taxpayer's on the hook. As you go towards failure, the incentivization of management is to double, triple down because equity is approaching 0 and hollow out the core assets of the institution. When this Kansas bank failed, the failure was more expensive because the money had gone away. And the home loan bank super lean structurally sets it up to be ahead of the FDIC, to be ahead of the discount window. It structurally masks some of what's going on from the regulatory perspective. Had this Kansas bank gone running to the discount window, somebody may have been like, that's kind of a little bit odd. Maybe we should examine it, right? But instead, it's a delay and a structure factor. And I get it. The incentives of management as you approach failure are to behave very differently for equity than debt.
Okay. All right, I want to make sure that Joe and Stockton also get an opportunity, so apologies
Yeah.
that I, go ahead.
Yeah, well, thanks, Jill. And Aaron, I hate to blow up your theory because I think I'm going to agree with you, partly at least. I think you're right that banks that get in trouble historically, we've seen they've turned to the federal home loan banks. We've also, though, I think that history would show that banks that get in trouble and then get back out of trouble because they've turned to the home loan banks. So you can point to the failures, but it's harder to point to the successes because it just doesn't, it's not as transparent. So, the upshot of every banking crisis that I've seen in my career has been, the home loan banks get blamed either for making the crisis worse by cutting off lending too soon or for continuing lending longer than they should have. So I think part of your premise is right. I don't think, though, that the solution is to make it harder to borrow from the home loan banks or to force banks to go to the discount window or other things. I think all of those things can have a discussion, but they need to be discussed in a very open and transparent way that maybe leads to improved coordination between the prudential regulators and the FHFA or the federal home loan banks as a bank looks to tap them. But any kind of a knee-jerk reaction that is, we've got to make it harder for a bank to borrow on a day-to-day basis from the federal home loan banks, or we got to shift everybody to the discount window, is that's only going to create more problems. The better solution is to look at these things and make sure that everybody's at the table as we talk about it. And these conversations are going on, about, should there be assets, should we force banks to be at the discount window? Well, okay, that's great. Maybe we should look at that, but the home loan banks are recognized as a lender of last resort in law right now. So you got to deal with that. You've got to look at what happens if you're going to force banks to pre-position a lot of assets at the discount window. How much liquidity does that take out of the system, and what does that do to the economy? So those are all things that are solutions that I think create a bigger problem, I guess is what I'm getting at.
Okay, I'm going to invite Stockton to get in on this.
I don't have a whole lot to add to that part of the discussion, but just to observe that SVP and Signature were significantly involved in affordable housing financing. And anytime there's disruption with a few banks, or more systemically, as in the meltdown of almost 15, 20 years ago, at some point somebody says, well, it's because these institutions were over-involved in quote-unquote affordable housing. And usually what happens after some more sober post-mortem is conducted is it turns out that had absolutely nothing to do with it. So I do want to make that point here, and I think that would be a point that the banks in particular would agree to. As far as the role that the FHLB played in this most recent episode, I don't really have anything to add except that the stability that was provided certainly was beneficial to the institutions that are serving the lower end of the home ownership market and financing affordable rental construction. So in that sense, I saw it as constructive.
So I don't think SVB was doing squat other than protecting venture capitalists and lending big fat checks to Mark Andreessen, who then ran on Twitter calling for a bailout and is now trying to shut down half the government with the Doge Bros. It's infuriating to me that SVB was called a regional bank. SVB, it was about the same size as M&T. I'm a Marylander. M&T used to be our largest bank till it got bought and headquartered out in Buffalo. About the same size. M&T had 1,000 branches. SVB had 4. SVB didn't bank people. SVB banked fintechs and startups and cryptos, Roku and stable coins and stuff like that. And I think that too often, the pennies that go to affordable housing get caught up while the dollars are stolen from people in society.
But some of these institutions were, and this relates to them having the very high net worth deposits that, of course, ran some of the large banks that failed. They were lending, they were doing mortgages to the high net worth clients. Those mortgages, unfortunately, also, just if I may, increased their, I'll call it structural balance sheet problems, because they initially funded them with deposits. If they had funded those instead, like let's take First Republic, if they had funded that instead with a home loan bank advance, they would have been in a far different.
But the First Republic business model was, I'm going to give the corporate treasurer a below rate jumbo loan on their mansion and think they're going to leave their money with me. The SVB model was, I'm going to have SVB Capital make a small equity thing in your startup and structurally put in the indenture that you can't run. Those were two different models that they convinced the regulators, and this is where I disagree a little with Joe. My solution isn't to put up the Federal Reserve in the discount window. I agree with you. My solution also isn't better communication, because I don't trust the Federal Reserve as a bank regulator one iota, and communicating its position to SVB would not have improved its regulatory quality, particularly while the CEO of SVB sat on the board of the San Francisco Fed.
Yeah. I think, and I don't know if you would agree with this premise, Aaron, and I'm sure that maybe Joe might disagree with this premise, but at Moody's, and certainly I have a co-author here who we have a forthcoming paper about SVB, I think the view that prudential regulation, the lack of some things like interest rate risk and the LCR. I don't think that what happened in terms of Agrippa was positive for banks in the asset size that all of these institutions that failed in 2023 were. And I think if one wants to, I'll call it, find really a area where there were opportunities to have done different, better, whatever, not having quantitative guideposts for interest rate risk, for examiners to use. If you read the examination manual of the Federal Reserve on the topic of interest rate risk, it's a page and a half. And there's nothing quantitative in it whatsoever. They're not the only one, but I know there's the best because I worked there. And then when you get to the fact that the LCR, the liquidity coverage ratio, was taken out of all of these banks by the tailoring in 2018, that also, I think, was a contributor. So, if we had had real liquidity buffers that were being marked to market by these institutions, maybe it would have been different. Well, this was an exciting first question. Let's maybe turn to something that we could talk about, where there's an opportunity to, something that we think that the home loan bank system maybe could pivot or do differently. Something that is an opportunity to change as an organization is at 100 years that you would argue needs to be different. So maybe, Joe, I'll start with you since you're...
Wow. Actually, my answer to that is not much.
Okay.
We think that, the home loan banks function really quite well. They are relied upon by banks of all sizes for day-to-day liquidity management, sometimes more than day-to-day liquidity management. We're, again, going back to, better communication, better prudential regulation. Maybe not, you're right, I might not agree with you entirely
I kind of
on
suspected you might
what
not,
that
but.
looks like. But, SVB, there were failures there that were prudential regulatory failures. we should...
Yes, they were.
So,
That's very fair.
So better oversight, better improvements that way. But in terms of the overall mission, the overall structure of the home loan banks, no, I don't think there's a lot that I would change about the core mission. We hear a lot from our members when we get in, this is an affordable housing discussion. I think there are changes that we would like to see to make the affordable housing programs more efficient, and to get more bang for the existing buck. But other than that, we don't want to upset the apple cart.
Okay. All right. In an era where there's a lot of apple carts being upset.
There's a lot of apple carts being upset.
Okay.
Yeah.
All right. Stockton, I wanted to invite you into your thoughts on...
Well, I'm here on behalf of state housing finance agencies, which are important partners of the federal home loan banks. They're not actually members of the bank system, though. They're what are known in the statute and regs as housing associates. An obscure term, perhaps to many of you, even FHLB diehards. Now, the mission of the Federal Home Loan Bank system in law and regs actually talks about providing financial services and products to members and housing associates. So we're sort of right there on, first line. Certainly implies a rough equivalence, but housing finance agencies, to be clear, as associates, are not members. They don't receive dividend payments, for example. Their collateral is treated somewhat more narrowly. They don't directly access the affordable housing program, but they do a lot of other things that we'll talk about as we go through the discussion today. But in terms of sort of changes and things particularly related to affordable housing, I think what hopefully our whole day together will illuminate is the Federal Home Loan Bank system and the banks do have some mandatory, statutorily required affordable housing programs. The affordable housing program itself is one, community investment program. There'll be panel discussions on those throughout the day, and they're certainly very important. But much less well known are a set of voluntary initiatives that are either explicitly blessed in regulation or just happening with housing associates like housing finance agencies. Whatever the opportunities may be through regulation to do more through those official authorized affordable housing initiatives, and that's also probably a discussion. There is enormous wide open territory to expand the voluntary initiatives, and there's a lot happening in that space. Pretty much every Federal Home Loan Bank I can think of is doing more in the voluntary collaboration with housing finance agencies and others than they're typically given credit for, or maybe doing as much as we together should be to promote. So I would like to talk about some of those opportunities as well as some of the more regulated authorized programs.
Okay. Oh, that's great. And Aaron.
So I have a long list of reforms, but I'm going to stick to your question,
Yeah.
which is what could you do more of? And I'm going to say two things. One, more affordable housing. I think that 10% should go to at least 20. That was the position of the last administration. I'm not sure I agree with the methods upon which it was communicated, but the Rev Corps money went away. It's amazing to think how long it took to pay off the taxpayer bailout of the 80s. It's a shame we didn't have more of a pay for as a result of the taxpayer bailout of 08. But that money shouldn't go back into profits. I think it should go back into affordable housing. I think there should be more, whether it's done voluntarily or statutorily. Second, I think there's a massive opportunity for home loan banks to do more in the 5 to 49 multifamily. And the reason I've come to this belief is that and your lecture was deeply illustrative. I kind of want to go to A&M and take your class. In the way in which technology and commoditization structurally have changed things. So in the spirit of your lecture of structural changes, we have come into much more of a commoditized lending world, which serves the 1 to 4 unit structure incredibly well. And why is it 1 to 4 units? I think you have to go back 100 years to figure out why a 4-family unit is treated differently than a 5-family unit. Right? The economist in me doesn't get that discontinuity, but it's real. And the 50 and up market, I think that society's worked, the private sector has gotten a pretty decent handle on. But this 5 to 49 is a struggle fest. It doesn't work with the great secondary and securitization market. These projects are often bespoke, the variance between the size, there's often a mixed use component to it. And it's just difficult to securitize and bundle it for a variety of reasons. And as somebody who was on the housing task force when I was at Treasury and was really interested in structurally promoting more mixed use units, and while I would love to see local zoning relaxed, the rise of NIMBY liberalism in America has been deeply pernicious as it relates to affordable housing, as it relates to mixed use, frankly, as it relates to broader things in society. I see it in my home, deep blue county of Montgomery County, Maryland, where, God forbid, affordable housing is put in certain communities. That's against the environment. Somehow it's environmental to have people drive 30 miles. And so I would think to myself, God, wouldn't it be amazing if there was some liquid, bespoke secondary market that could provide areas to these community banks, which actually tend to specialize in the 5 to 49 because it's too bespoke for the giant banks and the credit unions, et cetera. It's too much of a project. and there's a risk element for local banks to get too deep into their local real estate. You couldn't create a better system abstractly than the home loan bank system would to exist and fund that type of structure. And I would just love to see a double or triple down into growing that element as opposed to just a simple, I'm going to take a Fannie or Freddie and pledge it as a security and get an advance and do whatever with.
Can I give you a specific example of one tool that could accomplish exactly what you're talking about? Allow the banks to buy participation interests in multifamily transactions that housing finance agencies do. This isn't our idea. This is an idea in a letter that the 11 Federal Home Loan Bank presidents sent to FHFA and Treasury last year. All FHFA has to do is tell the banks that this is okay. It doesn't require regulatory or even administrative action. You could add a tool to the toolbox that does exactly what Aaron's talking about.
Yeah, and I'll
We've
just,
solved the world's problems. Wow.
yeah. I must have gotten up on the right side of the bed because I'm feeling especially agreeable today. But yeah, no, I agree. And Aaron and I have talked about this in the past, that, the 5 to 50 is a sweet spot for community banks. I think that's a great idea that you've mentioned. So whether it's through other voluntary programs or leveraging affordable housing in a different way, I think there's a lot of potential there. And now it doesn't solve, as you noted, some of the NIMBY issues and zoning and other things, but it's a tool that is, with a few tweaks, I think pretty readily available.
Yeah, and it goes a long way because a lot of the zoning you have by right to go to a 5 to 49, but you struggle to get financing for it. And then you want to go above a 50 unit and you need a zoning allowance, and then, the NIMBYs descend. So it's kind of a workaround. It's kind of recreating like Queens and Brooklyn in a way in other places. And that scares a lot of people, don't get me wrong. But I tend to think some of these old city designs are implausible, or not implausible, but are deeply structurally tilted away by our existing financial system.
Yeah, no, and what you guys are talking about is very interesting because when you think about how banks typically fund this, a lot of times they do fund it just with deposits. And when you get into, I'll say, kind of multifamily CRE, I'll call it stress scenarios in banks, some of this relates to the fact that, the first leg of your stool in terms of any bank's credit profile is, of course, its profitability. And when you get in that situation where the deposits are repricing, as has happened with, there's a bank that I can think of that's in New York with the big multifamily book. So, when you get in those kinds of situations, the fact that you deposit funded it as opposed to having an advance backing it actually also creates banking sector problems, which has got broader ramifications that are negative that we would like to avoid. So maybe we can all sit down and write a letter after this. And our panel agreed on that. So I wanted to maybe take the question next to, in the current macro environment, where we are today, what do you see as the most important role? I think you kind of maybe already answered this a bit, Aaron, but that the home loan banks are playing. There's a variety of roles that they play, but maybe Stockton, I'll start with you first, and I think I know what your answer will be, but.
Well, talked some about multifamily financing. Obviously, we don't have enough affordable and middle market apartments in the country. There's also a huge home ownership challenge, working with housing associates like housing finance agencies and member banks in the system. The FHLBs are doing a lot to support down payment and really stimulate the demand side. There's plenty more to be done there, but clearly, if you kind of ask the housing finance agencies in states around the country, the number one thing they're thinking about in the home ownership arena is the lack of supply of starter homes, entry-level homes, whatever we used to call them, that really hardly ever get built anyplace anymore. And if there are opportunities with HFAs and FHLBs and others to look at financial products and resources that can help stimulate more affordable starter home construction, I think that would be a win-win-win across the board.
Okay, maybe we're going to go in reverse order now. Joe, I'll let you go next.
Sure. Well, I mean, at core, I think the question is what's the most important function?
Yes.
It's the liquidity function. You started out with it. The survey that showed liquidity is a high concern among community banks. That is the ultimate. We see that as the ultimate primary role of the system. It's the one that drives the affordable housing, because the income that's generated from the provision of liquidity drives the affordable housing. We can argue about whether it should be 10% or 20% or something, but it does. It drives it. It addresses that concern. It provides that income that feeds the affordable housing. But it also is, I think, too often lost that the provision of liquidity, some of the direct investment in housing gets missed. And that's because of other regulatory changes. And I don't want to come out in opposition to, ability to repay and all of the changes that came from 2008. We struggled with those, but I think it would generally be agreed that those have improved the entire mortgage process. But it has also driven a lot of banks from direct mortgage lending. They just can't afford it. But what gets lost is that there's a huge amount of warehouse lending that gets done. Mm-hmm. And it's done from banks that are borrowing from the home loan banks. So my colleague Dan in our economics area has done some research showing that there's at least $134 billion of warehouse lines that are out there that are supporting housing. And that's supported from the banking industry because of their ability to access the home loan banks.
Yep, I've seen that in my supervision career, people using the mortgage warehouse to pledge the home loan bank and get financing. So.
Well, we can have a different conversation. I think Barney Frank had the best quip, which is QM was the exception that ate the rule. Barney was always particularly quick-witted with those quotes. Look, in today's macro environment, I'm terrified because we have a group of people in charge whose job seems to be to break government. And it's really fun to break things. It's a lot harder to break than to build. I like to take a sledgehammer and swing it myself to relieve my stress. But like taking a sledgehammer to the structure is scary. There's a lot of things that, shrapnel explodes. On my walk over here this morning, I tried to go into the CFPB and the door's locked. What if they lock the door to FHFA? What if they lock the door to HUD? What if they lock the door to FHA? I mean, you can't destroy things and expect the system to work. I remember during the Tea Party, you guys remember that famous sign, "Keep the government out of Medicaid"? Or Medicare, I think it was. When they were talking about Obamacare. Keep the government out of housing. Where's your mortgage? How does this process work? So what terrifies me right now is this zeitgeist on the macro level. And it's one thing to throw 25% tariffs, blah, 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 jitter the market, generate headlines, negotiate a deal so the thing never occurs. When we were doing housing finance reform and we were throwing out different options, I was always struck by what happened in England, which was the way their housing system works, and I tend to think the covered bond system in Europe is an analogy to the home loan bank. It's not perfect, but it's at least reasonable people can see it as an alternative structure that has a lot of similarities. And the European model, where they don't have a 30-year mortgage with a one-way optionality to repay, because without some level of government, I don't think the private market will ever get there. I'm unaware of an example of it in global history. Mm-hmm. Yeah, the mortgage market just doesn't work for a few months when there's a crisis. And if you want to build that type of mortgage market in America, you can. You will reduce the chances of a taxpayer bailout, but you could have a system where you just can't get, there are no mortgages for 3 months. Anybody try to get eggs recently? Right? Like, that scares me. And if you want to intentionally build that system for a bunch of financial stability or other purposes, okay. We can have that debate. I think a reasonable person can make that proposal. We'll see how far it goes. But if you accidentally shut down the mortgage market for 3 months, because you're swinging the sledgehammer, and it terrifies me. So to some extent that people have access to the folks in charge, like, please don't shut down FHA. Please don't shut down FHFA.
Right. Nope. Residential mortgage would be very bad to shut down. So yes, I very much agree with that. I guess from my vantage point, and I sort of alluded to this in my remarks, but I think a couple things. The amount of stable funding that can be provided to banks at a time when the government, is trying to, when there's a lot of, I'll say, investor concern. And what's going to happen with the 10-year term premia is not obvious in terms of the 10-year treasury. I think it's really important that banks have, particularly smaller banks who are less sophisticated and aren't able to issue debt independently, have that access. And I think the housing, I love the conversation that we just had about multifamily and thinking about, are there ways to make that kind of more clearly part of the remit. I think that's very important for the reasons that we talked about in terms of just generational opportunity. And then I'm going to come back to my small business proposal because I do think that the real risk when you have a highly levered government is that it crowds other things out. And that's how you get to, I'll call it kind of a feeling of, instead of exceptional US economic growth, a feeling of malaise and that the economy is not working well.
So there's a really interesting study that just came out, David Leinhart wrote about in the Times. The US has had exceptional economic growth relative to Europe since the financial crisis, and particularly relative to COVID, and simultaneously a massive feeling of malaise. We are less happy, we are less excited. I have a forthcoming paper with Carol Graham from Brookings looking at that, the delta between happiness, consumer sentiment, and performance. Europeans are happier about their economic outcome, which is dispositively worse by any macro measure, right? And I think that the rationale why is twofold. One is we've really distributed it incredibly heavily to the top. Right? I encourage you to look at polling by choice of presidential candidate by how far you live from your hometown. The people who have moved are generally the people who have done better economically and who are pleased with this global world order. I am an anomaly. My kid goes to the same my two daughters go to the same high school and middle school I went to. Those people overwhelmingly voted for Trump and overwhelmingly are less happy about their economic outcome. Simultaneously, you've seen an increase in political polarization where you ask people about the economy, it's becoming the question of, is your president in power for Republicans? Not so for Democrats. So you can go back and forth and look at consumer sentiment based on White House, and you see these sharp changes around the election control. But you can also go back and see the economy. For whatever reason, we've tended to have economic implosions around presidential changes of control. The last one is an exception, but 2020, 2008, 1992, it was the economy, stupid. And then you have a few control moments, 2000, et cetera. And what you've started to find is in the past, people kind of like, there was a little bit of a change, but it was kind of even. So the macro number stayed constant, the same number of Ds in R switch. Now, when a Democrat wins, the Republicans tell you the economy's in crap, but the Democrats don't change as much. And so you've had this odd situation. I'm still searching for an explanation, but I'm increasingly coming to this political polarization element. Maybe there's another example. Maybe it's the makeup of the parties have changed. I don't know. But I am very worried about this.
Yeah, I think this gets a little bit back to some of the generational comments that I was making as well. And just, Texas, I think it's fair to say that many people, and I think correctly, view Texas as having, a very supportive business environment, an environment where, at least historically, homes were more affordable, and perception that there's greater economic opportunity. But when I have students come talk to me during office hours, after we get through the questions about the lecture or the homework, oftentimes there is, I will say, it's kind of like just a concern for the future. and a concern about, I've had several students ask me, Professor Satina, will I ever be able to afford a house? These are kids in Texas, which is, again, an environment where it's fairly easy to get permits, build homes, whatnot. So I do think that there's, I'll call it a telling generational dimension as well. All right, I do want to open it up for questions from the audience. Hopefully we have some. Do we have some questions? All right. All of that and us having debates and consensus, I would hope that we could have some audience questions. Thank you. All right. Are any federal home loan banks using FHA's, risk-sharing program to expand capital available for affordable housing? Should they be? So I don't know if...
So that's a good question. That sounds like somebody who is very expert on housing finance agencies as well as the role of FHLBs. I don't know, Garth, did you send that question up here? Garth Riemann, my colleague at NCSHA. Housing finance agencies are able to provide loans for affordable multifamily apartments through a variety of means, one of which is by using an FHA insurance program where the state HFAs and the federal government through FHA share the risk. It's worked so well for 30 plus years that it actually generates probably a term near and dear to you, a negative credit subsidy. This actually makes money for the federal government. So there goes your risk profile. This is a very sound and efficient way to provide financing. There's a wrinkle on it that's available to get additional capital in from the secondary market by accessing the federal financing bank at the U.S. Treasury Department to further enhance the liquidity for this type of lending and to bypass a number of assuredly important but nevertheless very, very time-consuming FHA multifamily rules in the FHA multifamily MAP program. This also generates negative credit subsidy and provides financing for all kinds of transactions that wouldn't otherwise happen. As to the question of whether members of the FHLB system are parties to these transactions, I think that's the question.
Yeah, risk sharing.
Undoubtedly so. I don't know if I have a list off the top of my head, but we could certainly do some follow-up and point to examples where the Federal Home Loan Bank member is also participating in this kind of activity. There may be a related thought if there's folks from mortgage bankers or other groups, could other lending institutions have the same access that I'm describing as being so efficient and low cost? We would be all for that. That would be a decision that FHA and the Treasury Department would have to make, and we would be delighted to see that because it gets more lower cost capital into harder to do apartment financings.
Okay, thank you for that, Stockton. Other questions? Thank you so much. Okay. Can you comment on the recommendations in the FHFA's System at 100 report, both in regards to the safety and soundness and the affordable housing recommendations? Okay, I think everyone should have a chance at this one, so maybe I'll start with you, Aaron, and we'll kind of work down, and I might offer something as well.
Yeah, I mean, as I said before, I think they need to do more in affordable housing. I think, the RevCore obligation should go straight to affordable housing. I think that's in and of itself a no-brainer. I think the report generally did a good job. I probably would have gone a little further and had a few more recommendations, but I tend to think the report generally did a pretty good job. I think there are a few things they punted on where they have more authority. They just were a little afraid to use it. I kind of fear that the next administration is going to be comfortable using authority they don't have. So if the current administration stopped short and said, well, I could do this legally, but I'm a little scared too for the backlash, so I'm going to say I can't. This next administration is going to be like, sue me. And that terrifies me more than my criticism of the former. But I think that the total dollar amount to affordable housing, by the way, that's not inconsistent with the comments that some of my fellow panelists made about streamlining it, making it more efficient. I'm a little concerned about kind of how it's allocated, who gets to make those choices. But that's a little bit of a different subject. But they're not putting more money into the pot is not inconsistent with changing how the pot is allocated.
Well, let's see. Start with the System at 100 report generally. I mean, we welcomed it. We think, it's always good to have the regulator. We did take some issue with some of the assertions that, in its 100-year history or nearly 100-year history, the home loan banks had escaped review. Well, that's just not true. I mean, Congress has changed the system multiple times, all of that. So we took some issue with that. I also think that with SVB and Signature happening, it changed the focus sort of midstream as they were looking at it. So I'm citing all of that as a way to get around to, and I think, again, I'm going to agree with Aaron to a certain degree. I think our biggest concern with coming out of the report is how they would how FHFA started to go about implementing some of the things. And what I'm mostly concerned about there is through guidance. We would much prefer that when FHFA makes changes, we'd much prefer when I think any regulator makes changes, that they do it through notice and comment, through a transparency and giving a chance for affected parties to have a seat at the table. So some of the guidance around credit ratings of the banks and their members have caused us some concern. I don't know the direction that FHFA is going to go with any of that going forward, but again, we hope for a more transparent, open process. Same way with affordable housing. I think that just what we talked about here with the 5 to 50, having an open, transparent, bring us all together to comment on that in. There's a lot more agreement on that than there is disagreement.
We're going to write the letter. We're going to write the letter after this, this panel.
So.
I don't have much to add. I mean, my recollection is when the process started, I felt like FHFA really worked hard and did a lot of listening sessions and really tried to, encompass a range of viewpoints on a very large set of issues. And then, intervening events occurred between when it started and when the report came out. And, by that time, it felt like maybe a little of the momentum had gone out to sort of pick and choose some things to focus on. I mean, bank membership, right? You could have done the whole exercise on that one topic, or the role of the system and, with respect to distressed member institutions. To be honest, I mean, by the time the report came out, the discussion of affordable housing, with the exception of, as I remember, some specific comments on the affordable housing program, again, only one of many tools that are available to the FHLBs was, I think, pretty limited, and that probably represented a missed opportunity.
Okay. Maybe just from my viewpoint on the report, one of the things that struck me was, and again, I'm more of a banking person, less of obviously affordable housing person, but was the fact that the report seemed to, in my view, kind of conflate the home loan bank's liquidity provision role with the role of providing what I'll call term funding. And those are very different tools from a bank viewpoint. I also felt like the report had some challenges in terms of, the purpose of the discount window, and I've been involved in my career in discount window lending. It is never to provide, a permanent source of funding for a bank. And so I felt at times when I was reading the report, like this idea that, well, we're just going to have the Fed or the discount window somehow replace what the home loan banks were doing. It's one thing, perhaps, if you're thinking about a true resolution scenario where you're going to have, okay, we're going to shift that responsibility for liquidity provision and resolution. But on I'll call it going concern basis, that struck me as kind of a bit of I guess I would say a disconnect. And I think that really the suggestion as well that, and this is, I think, more from a market perspective, having spent time, at Moody's, but the discussion that maybe, we keep focusing the home loan banks more and more on affordable housing. I think that for many who think about home loan bank debt, right, we often talk about the advances. Now I'm going to talk about the home loan bank's liabilities. But what makes the home loan banks arguably unique, what makes them systemic, is their unique connection to the banking sector in terms of providing that term funding. That's, I would argue, what makes it unique, whereas we have Fannie and Freddie as well who provide housing finance and are less unique. And I felt a little bit that FHFA as the regulator perhaps didn't think about that or understand that perhaps in the same way that some of us at the rating agency may have looked at it. So just a very, very interesting report. Very important.
Yeah, Jill, if I could just chime in there, because I want to agree with you. One of the biggest, and I don't know if I would put this squarely on FHFA or the report, but one of the concerns that I've had in the last couple of years as we've been talking about this is this conflation or this idea that somehow the discount window and the home loan banks, you might only need one, not the other. And they exist for two very different reasons.
Correct.
And I don't think that we don't want to lose sight of that. To Aaron's point, it's a lot easier to blow something up than it is to build it. They were both built for specific, still existing reasons. So we want to be careful how we move forward.
Yep. No, absolutely. Thanks for that, Joe. All right, we got more questions. So, how can insurance company members of the home loan bank system better support affordable housing? Is there a role for the home loan banks to play in reducing insurance costs in the affordable housing space? Anybody have any thoughts on this topic?
So I love the insurance questions. It's not nearly thought of as much in Washington because we're the only major country without federal insurance chartering or regulation. And the purpose of the system was very much, in a pre-Fannie Freddie world where the insurer was the buyer of the long-dated asset, and it was a good way to match long-dated obligations. And I think insurance companies can play much more of a role in that situation. Unfortunately, there's a temptation in the insurance side to chase yield in the mortgage rates, and the common narrative is that AIG was blown up by its financial products and subprime division, but if you actually dig in deeper, you'll find they were massively in subprime mortgages. There's a great paper by Hester Pierce, then at the Mercatus Center, now at the Securities and Exchange Commission. And so I think insurance companies could do that more. That's why they're in the home loan bank system to begin with. You talk about banks funding these things in deposit. You could find insurers to fund them on their balance sheet. You'd obviously, have a liquidity issue, and this is where I think the home loan banks could help on the insurance side because, in the liquidity issues there. I mean, insurance companies usually, when they do fail, which is rare, and I'm talking more about life and property and casualty, not health, but I think that's the purpose of the conversation. So I think there'd be a lot more to do there. The home loan bank could play an important role as a convener, I think particularly working with some of the funders and projects. Maybe you guys have more specific ideas.
It is an interesting idea to make it part of the convening with the federal home loan banks. I mean, certainly insurance companies do play an important role in multifamily financing and commercial real estate generally. I think there was another part of the question about insurance costs. I mean, it's a huge problem right now. Everybody knows what's going on with single-family home mortgage insurance around the country in more and more markets. But, maybe this audience is less familiar that all kinds of insurance have skyrocketed for multifamily apartment development, especially for property operations. So that's creating an enormous amount of stress on the rental apartment side, not just limited, but especially concentrated in the affordable sector.
Joe, did you have any thoughts on that?
I have lots of opinions in this space, but less official expertise, so I think it's best if I keep my mouth shut.
Okay, all right, fair enough. We've got quite a few questions here. I'm going to try to get through a few more. So, Aaron, there was a question for you that was directed to you. So, Mr. Klein, you seem to criticize the low amount and intersection between the prudential regulators and the FHFA. How would you fix that? So, what could you do in terms of bank regulators and FHFA to improve communication? I have a thought on this too, but you go first.
Well, in your lecture, you talked about consolidating the bank regulators, and I'm very proud to say that Senator Chris Dodd, my former boss, proposed that, the original version of Dodd-Frank consolidated bank regulators. There was a vote to strip that, put the regulators back in their boxes, and it passed 7-90. So you're going to see Congress do a big show and dance today and tomorrow about the Federal Reserve, and they love to beat up the Fed, and particularly the Republicans. When push came to shove, and there was a proposal on the Senate floor to consolidate the regulators, there were 7 Democratic members that voted to do it. Every single Republican, along with the vast majority of Democratic senators, voted for the status quo. The amendment is the Klobuchar-Hutchinson amendment to what became Dodd-Frank. I note that because you have a senator from Minnesota and a senator from Texas. What do they have in common? Well, they are 2 of the 11 states that have Federal Reserve banks. And so that's where that came from. The regulators in public pledge better cooperation always, and then in private, they knife each other in the back. And they guard information zealously. I've, in the think tank world, proposed merging the regulators on a paper. I proposed doing a joint exam force, which I think is something that maybe the bankers would be a little open to, rather than have the FDIC regulator come and the Fed come and the OCC. Maybe they all just sit in a room together and ask one set of coordinated questions and share their information. I've also, and this is like Mr. Radical Transparency, I've also written that we should make bank camels public. Per the question about getting into we don't know what's really going on. I would argue that the largest banks' camels are de facto public because they can't be given a 4 or a 5 because they'd end up on the troubled bank list. So I have a bunch of explanations in that, but I fundamentally fear that Congress gets rope-a-doped every time by this. We're gonna just communicate better, and then we'll solve it, and then it just doesn't happen.
Yeah, no, number of great points there, Aaron. Did you want to get in on this in any way, Joe? And then I'll go ahead.
I'm gonna no. I mean,
You're gonna skip that
one. given the current state of things, I think it's best to pass.
Okay. Yeah, I guess I'm going to tend to agree with you, Aaron, that I think we kind of give ourselves a pass on real reform and kind of continue on with the current system. And I think a really interesting question. You look back at the material loss reviews and the data that came out after the bank failures. They were all well rated. Why wouldn't the home loan banks have lent to them? The communication that was being provided through those ratings was very poor. And it was actually a fascinating transition to go from being a bank regulator where ratings were private to when you're actually at a rating agency and you have to state publicly where someone is. And I think there's a very healthy thing in that. There's accountability in that. You will have people call you up and debate you, and say, hey, I agree or disagree with what you've done. You get feedback, whereas in regulation supervision, it's all, we go through the exam vetting, we assign the rating, and then we park it and forget it for 18 months. Yes, there's some continuous monitoring, but it becomes very individualistic about the quality of that.
So my experience comes from serving on the TARP Investment Review Committee at Treasury, and by the time I helped draft the TARP legislation, but by the time I got to Treasury, the big guys had all been done. So it was just the little guys. And I got to watch the Investment Review Committee only got things where the 4 regulators disagreed. So if you may recall in the structure on TARP, the bank had to be ongoing viable. And so if all 4 regulators thought this made sense, it went through. If all 4 regulators said no, it didn't. And then the ones where there was disagreement got sent to this review committee where I served. And it was fascinating to me to watch the regulators take different positions depending on who the bank was regulating. So you see these things with almost identical balance sheets where the primary said A here and the other guy said no. And then when you flipped who the primary was, and then you'd see the way that these folks would get rated on management and you'd get rated on even on earnings. And there was so much divergence, so much opinion. It struck me, and no accountability. I mean, you just see these things, you can be like, how could you take that position? I saw instances of what I believed were racism. I saw instances where it was just implausible to me of these things. And it deeply disturbed me. And I said, how can you structurally create accountability when all of the data and information is private? So it would be a huge shakeup. I know it would make a lot of people uncomfortable, but anybody ever walk into one of those states where they put the letter grade on the restaurant?
The health inspection, yeah. Uh-huh.
Like when I walk past and I see a C, I'm kind of keeping walking. Right. And maybe that over-empowers the health inspector. Maybe there's some restaurants that are given a C unfairly. I will acknowledge that as a reality, but I will absolutely tell you that the letter made a difference in where I ate.
All right, with that, I apologize to those who asked additional questions, but we're a little bit past time. So thank you to my fellow panelists. Thank you to the organizers.
Well, I'm happy to say that the Press Club's lunch gets an A. Thank you, everyone, for that lively discussion. It did not disappoint. It's now my pleasure to introduce Jeffrey Kuzbel, President and CEO of the Federal Home Loan Bank of Topeka. Jeff has led the Federal Home Loan Bank of Topeka since January of 2024, after serving as its Chief Financial Officer since 2021. Prior to joining the Topeka Bank, he spent 12 years at Capital One Financial, where he ended his service as its LIBOR transition executive, leading the enterprise-wide program. He brings decades of financial services experience, including leadership roles at Capital One, the Federal Home Loan Bank of Pittsburgh, the Office of Thrift Supervision, and Freddie Mac. So please join me in welcoming Jeff Kuzbel.
Good afternoon, everyone. I'm Jeff Kuzbel, President and CEO of FHL Bank Topeka. I appreciate the opportunity to be here today to take a few minutes to share some thoughts on our bank, the FHLB system, and the role we are playing in housing. This opportunity, as well as the broader discussion, have proven useful to me as I'm completing my first year in the CEO role and my fourth year at Topeka. This isn't, however, my first experiences in the system. As was mentioned, I've worked for Federal Home Loan Bank of Pittsburgh, Freddie Mac, and Capital One. And working in these places, I've had the opportunity to observe the system and the GSAs, both as an insider and an outsider, and gain perspectives from both an urban and rural setting. As the discussion has evolved over the past few years, and now in the context of a new administration, I'd like to offer a couple of observations. First, lending looks different everywhere. That might seem obvious, but when you look at the middle of the country versus the coastal areas, there are big differences across the board. And also, too, it always doesn't translate into needs for smaller, less densely populated regions. Relationship lending is very real, and I think there are always opportunities to make changes both in rural and urban areas alike. Where I am located, the truck in the driveway or the machinery in the shed may sometimes cost more than a home itself. Despite the relatively low cost of housing in smaller communities across the nation, many of our small community lenders have exited the mortgage market. It's worth asking specifically why that has happened. Why does that remain the case? And of course, what should we be doing to reverse that trend? By way of background, Federal Home Loan Bank of Topeka is a $75 billion member-owned cooperative wholesale bank that supports the states of Kansas, Nebraska, Oklahoma, and Colorado. The primary mission of the bank and the system is to provide reliable liquidity to our members, banks, credit unions, insurance companies, and community development financial institutions. We accomplish this through various advanced programs, mortgage purchase programs, and letters of credit. When you look at the membership of our Topeka Bank, nearly 90% of our membership base has total assets that are below the community financial institution designation at a threshold of $1.4 billion. And we have no institutions in our district that are over $50 billion. we are the capital markets for our community financial institutions in our district. And this is a similar story to FHLBs across the United States, where 94% of aggregate members have $5 billion or less in total assets. Nearly all of the institutions are financially healthy and we predominantly serve as a lender of first resort to support liquidity needs, asset liability management, housing and community development. This brings me to my second and sometimes most troubling observation with respect to the ongoing discussion of the Federal Home Loan Bank system. The presumption that FHL banks only exist for so-called troubled institutions or in stressed environments. We as a system are the preeminent collateralized lender, where our advances are collateralized by single-family and multifamily residential loans, mortgage securities, and agricultural loans. The reality is that we are a fundamentally relevant part of our members' everyday operations. When you study the balance sheets of our members, wholesale funding in general, and advances specifically, represent a small percentage of overall bank liabilities. We sometimes characterize ourselves as the motor oil of the financial system to operate seamlessly and effectively, when we all know what happens when you take the lubricant out of the engine. It causes the system to seize. In times of crisis, such as the Great Recession and COVID and the events of March of 2023, our activities insulated the broader market and serve as a shock absorber in the early moments of any market stress event. Before federal facilities are established, it is critical that our members can instantly access and we can provide reliable and on-demand liquidity to prevent contagion. Furthermore, our mortgage purchase programs provide liquidity to residential mortgage originations and are unique to the alternatives of the Freddie and Fannie securitization. In many of my conversations with member institutions, they share the fact that they would not be originating 30-year fixed-rate mortgages if it weren't for our mortgage purchase programs. Why is this FHL background important? The answer is simple. Our foundational liquidity mission facilitates our housing and community building mission. This simple reality is too frequently lost in the discussion. Our programs vary across the country, spanning residential down payment assistance, multifamily projects, and community development initiatives. Additionally, in the past few years, all of the banks have created and executed multiple voluntary programs contributing a range of 3.5% to 10% of earnings, depending on the bank, with a uniform commitment in 2025 of a minimum of 5% of voluntary programs on top of the 10% statutory requirement. We are the largest source of private grant funding in affordable housing community development in the country. So believe me when I say we are doing a lot for affordable housing and want to do more. But the value of the cooperative can be scaled most efficiently through the foundational mission and architecture of the Home Loan Bank system. Personally, in Topeka, we are very excited about our voluntary programs. We rolled out our inaugural Homeownership Possibilities Expanded program called HOPE. And this program is targeting the missing middle to support workforce housing by expanding our adjusted median income requirements. The program was met with a huge success and is benefiting first responders, manufacturing workers in Nebraska, and seasonal workers in Colorado. We, along with other banks, specifically Des Moines, Dallas, San Francisco, recognized opportunities to support Native American communities in our respective districts. According to HUD, Urban Institute, and other academic studies, Native American housing with respect to homelessness, supply, overcrowding, and lack of plumbing, heat, and safe water represents significantly worse housing conditions than any other demographic group across the United States. We are proud of our Native American Housing Initiative program that we call NAHI, that began in 2023, expanded in 2024 to include 12 projects, and we're seeing additional growth expected in 2025. Projects like 2 youth homeless shelters, where young teenagers were living on the street, living in cars, living at neighbors' houses. We, with our program, created a place that they could call home. We funded a community center and tornado shelter to support tribal elders in Oklahoma. We learned that life expectancy for Native communities was significantly lower than national averages, so we supported home rehabilitation programs to renovate homes of tribal elders to make bathrooms safe and accessible. The message here is that we are creating housing programs that meet the unique needs of our respective districts. This is similar to our sister banks like New York, Boston, Indianapolis, San Francisco, who have programs to support housing in the inner cities, banks that are supporting rural communities, economic development, and unique programs in Dallas and Chicago targeting CDFIs. The housing challenges facing this country are sizable, and we have an opportunity to make a difference. Whether you are a prospective home buyer, a renter, a senior citizen, we have an affordability issue and an availability issue. I prefer the National Association of Home Builders term, improving housing attainability. The challenge I see is that most of the programs over the past 25 years have been demand-side programs, our FHLB programs included. We provide grants, down payment assistance, mortgage rate buydowns, which are similar to other federal and state programs. I fear that we are increasing demand while housing supply is constrained, resulting in further supply and demand imbalances. The result is a perpetual increase in house prices, which raises rents and puts housing attainability further out of reach. The challenge is increasing supply. There are numerous factors such as land availability, zoning, material costs, labor availability, taxes, regulation, green initiatives, and more recently, higher insurance costs that impact overall cost and the ability to increase supply. FHL Bank Topeka works with our Affordable Housing Advisory Councils, congressional staffers. We have met with home builders, Habitat for Humanity. I've worked in looking at 3D printing operations, modular home builders, and academics to understand the art of the possible and the intersection for federal home loan banks. My fellow CEOs at their banks are evaluating creative ways to utilize our voluntary programs to make a difference for housing, community, and economic development. The FHLBs are in a unique position as a privately capitalized member-owned cooperative to address the distinct housing challenges in our respective regions. Our success in supporting our liquidity mission and foundational business model allows us to be successful in fulfilling our housing mission. However, success in addressing these challenges must be tailored to focus on how the FHL banks can make the greatest impact using the FHL Bank balance sheets and nationwide network of member financial institutions. The current and future reliability and stability of the FHL Bank funding to members through advances, mortgage purchase programs, letters of credit, will ultimately be the greatest determinant of success for housing attainability. We have demonstrated success over the 90 years through our core business and recently with our growth in our affordable housing dollars and initiatives, including the creativity and execution of our voluntary programs to serve unique needs of our districts and our member communities. We recognize the housing challenges and are eager to be part of, but better yet, the catalyst for a solution. We believe there are tangible ways to tailor regulations that support community lending, not just in rural America, but across the country. Fresh perspectives on manufactured housing, alternative construction methods, new products, and technological advances have fueled my personal enthusiasm for the change. And we are pleased as a system to continue to help and lead the discussion and subsequent transition with Congress and the incoming administration. Thank you for joining us and the FHL Banks and the Council of Federal Home Loan Banks for this important National Housing Conference. Thank you.
Okay, thank you, Jeff. That was great, and want to invite you all next door for lunch, and we'll come back here, and looking forward to a really full afternoon.